Let's say you wake up tomorrow to headlines screaming about a global market collapse. For the average investor, that means years of slow savings wiped out in an instant. But there's a select group of people actually opening bottles of champagne, celebrating the chaos. While the world is losing money, their wealth is quietly growing. The ultra-rich don't play the same financial game as everyone else. They don't rely on index funds or hope the market drifts upward. Instead, they operate in a world of private assets, off-market deals, and strategies built to protect and expand wealth in any conditions, a world most people never even glimpse. Over the next 8 minutes, I'm going to take you behind the velvet rope and show you how billionaires really invest. And once you see it, you'll never look at money the same way again. The Great Divergence. Most people spend their whole lives following a simple formula. Save what they can, buy a few shares, diversify a bit, and hope it all grows over the long term. They watch the news every evening, worry about every market wobble, and cheer whenever the charts turn green. This isn't how billionaire families operate. Their portfolios look nothing like that. The ultra-wealthy hardly rely on the public stock market anymore. While ordinary investors scramble over volatile shares, billionaires quietly shift their fortunes into private markets. These are art, rare spirits, land, private businesses, and assets you'll never find on a standard trading app. Their aim is to make money, preserve, and control it. They build their wealth to withstand inflation, political turmoil, and global uncertainty. They don't chase average returns because they don't live average lives. This is the start of the Great Divergence. Two financial worlds existing side by side. One chaotic, emotional, and risky. The other, stable, private, and remarkably profitable. Private equity. If you want to know how billionaires truly build their wealth, you have to look at the foundation of their strategy, private equity. By the time a company finally goes public and you're able to buy its shares, most of the real growth has already happened. The early investors, private equity firms and venture capitalists, have taken the genuine risks and pocketed the biggest returns long before the IPO. That's why billionaires buy into companies well before you've even heard of them. They give up liquidity in exchange for something far more valuable, the illiquidity premium. Rather than reacting to day-to-day price swings like retail traders, they invest for 5 to 10 years at a time. They understand the J-curve, the fact that private companies often look worse before they surge in value. While the public panics over quarterly earnings, billionaires review their performance only every few months. Their money is shielded from the emotional roller coaster of the stock market, and that distance, is one of their greatest advantages. Fine art. After building their stakes in private companies, the next place billionaires store their wealth is in high-end art. To most people, a Basquiat painting or a Koons sculpture is simply decoration. But to the ultra-rich, it's a form of currency. The global art market is worth more than $65 billion, and blue-chip art has consistently outperformed the S&P 500 over the long term. But the real magic lies in free ports, highly secure, tax-efficient storage facilities in places such as Geneva or Singapore. A billionaire can buy a $50 million painting, keep it in a free port, and sell it years later without the artwork ever entering a country, and without paying duties. It's wealth protection in its most elegant form. Art also buys social capital. Owning rare pieces opens doors to exclusive boards, galas, and networks where major deals are struck. In the exclusive world of the ultra-rich, art is both value and influence, a unique two-in-one investment. Liquid gold. Now we move from the gallery to the cellar. Rare whiskey and fine wine have become two of the hottest alternative asset classes. According to the Knight Frank Luxury Index, rare whiskey has risen by more than 300% in the past decade. And the reason is simple: these bottles are disappearing from the world. Every time someone opens a rare vintage, the remaining supply becomes more valuable. These investments age naturally, stay uncorrelated to the stock market, and often outperform traditional assets. A financial crisis might destroy a company, but it won't make a 1945 vintage worthless. But in this market, authenticity is everything. The documentation proving a bottle's origin can sometimes be worth more than the bottle itself, which is why billionaires pay a premium for flawless provenance. The tangible safety net. Let's talk about the oldest safe haven on Earth, gold. But billionaires rarely buy gold ETFs or digital contracts. They buy the physical metal stored in private vaults in politically neutral countries. Gold is the only financial asset that isn't simultaneously someone else's debt. But in recent years, the ultra-rich have turned their attention to something even more powerful: farmland and water rights. You may have noticed Bill Gates and others quietly buying vast stretches of farmland. And the reason is simple: land is finite. As the global population grows and climate change intensifies, the demand for food and water surges. The real value of farmland isn't just the crops, it's the aquifers beneath it. Water is becoming the blue gold of the 21st century. Farmland doesn't crash, it doesn't go bankrupt, and it doesn't depend on quarterly earnings. It grows in value and generates income, year after year, generation after generation. The passion portfolio. Finally, we step into the world of luxury, supercars, rare watches, and iconic handbags. These assets were once dismissed as extravagant toys. Today, they're taken seriously as investments. Thanks to the Veblen effect, as the price goes up, demand often rises with it. A limited edition Ferrari, a Patek Philippe Nautilus, or a Hermes Birkin doesn't behave like an ordinary consumer product. Their supply is deliberately restricted, which drives their value even higher. In some cases, buying a watch at retail is like receiving instant profit. A piece purchased for $50,000 can be sold the very next day for 3 times the price. But billionaires rarely flip these items. Instead, they build curated collections that function as a portable, highly flexible portfolio. These assets are beautiful, practical, and financially powerful. So, what can we take from all this? Even if you don't have millions to put into Picassos or private equity, the principle behind it is something anyone can use. Billionaires never rely on a single market. They collect assets that are scarce, stable, and uncorrelated. They buy things with real, intrinsic value, things that can't disappear overnight. That's how they survive crashes, inflation, and global turmoil. And it's how they keep building generational wealth while everyone else is panicking. Let me ask you this. If you were handed $10 million today, but you weren't allowed to touch the stock market, where would you invest it? Land, art, gold, something entirely different? Let me know in the comments. I'd love to hear your thinking. And if you know someone who's still stuck in the save and hope mindset, share this video with them. It might be the wake-up call they need. If you want to learn more about how the world's wealthiest people think, invest, and operate, make sure you subscribe to our channel, Luxury, Tech, and Beyond. Until next time, invest wisely.